Goldilocks may have had 3 beers, but the NZX50 will be hoping it stops at just one. After taking a tumble last week, the NZX50 officially entered a beer market. Here to provide some insight into the end of this fairy tale and the week ahead is Devon Fund's Head of Retail, Greg Smith. Welcome, Greg.
Great intro as well, really like that.
Well, thank you. Well, let's start with the NZX50 and that beer market. Is this something we should be worried about, or is this a good time to buy?
Yeah, I think you can certainly make that case. So a beer market is a fall of 20% or more from the most recent peak. So for the New Zealand market's case, that was back at the start of October, just before the RBNZ started tightening. So yeah, the market overall was 20% cheaper than it was back then. So yeah, I think there's certainly a case for buying. I think there probably also is a case for selectivity in doing so. You've seen lots of companies which have perhaps done well during the pandemic have fallen away a bit. Fish and Buckle Healthcare, that sort of springs to mind. Main Freight, it's fallen significantly. So yeah, are those tailwinds going to come back? Are they going to get back to their former heights? I think perhaps not, but certainly a host of high quality companies which have been tarnished during this market pullback. Strong cash flows, strong dividend yields. I think that's the other factor as well. You've seen the 10-year Kiwi bond yield reach 4%, which is coincidentally roughly the dividend yield for our market. So it's really raised that bar of comparison, I suppose. But yeah, I think there's some great companies that are trading at prices a lot cheaper than they were, but perhaps a case for selectivity, and maybe the rising tide isn't going to lift all boats as it has done in the past.
And we saw the March quarter GDP contract a bit. Should we be using that dreaded R word? Are we in a recession?
Well, yeah, some commentators are always saying we already are, down 0.3%. So, I mean, it wasn't huge. Obviously came after a quarter where the economy grew 3%. So again, a recession is 2 consecutive quarters of negativity or contraction as far as the economy goes. So we won't know that officially until the June quarter numbers come out, which will be sort of August, September time. But some are saying we're already contracting. I think you've got to look at their March quarter. Omicron it arrived with some ferocity on these shores. That was having an impact. Not saying it's all sort of bells and whistles or beers and skittles, as it were, just yet. But yeah, I think, obviously it was not a great time for the economy. Look, the job market's still pretty healthy. I think unemployment's at record lows. That's got to be a positive. Our exporters are still doing relatively well. We've seen the currency moderate as well. So look, I think there's a glimmer of hope there that can be avoided. Households have built up a lot of liquidity as well as spending. They've also shored up their finances, as it were, during the pandemic. So perhaps we avoid it in the June quarter, but yeah, we won't really know for a few months.
And can some sectors do well in this?
I think quite possibly, particularly defensive sectors, and those, and when we say doing well, I guess we're also looking at the share prices that investors might be paying. As I mentioned, some companies have fallen significantly from where they were, but defensively orientated companies, again with good balance sheets, strong levels of cash, and those with pricing power. I think that's a pretty key thing to be looking at as well. We're seeing inflation all around us. It's not just consumers being hit, it's companies as well. And those companies that are able to demonstrate pricing power or passing it down the line potentially could do quite well. So, defensively orientated companies. I think, some of those pandemic beneficiaries might find it a little bit tougher going forward. Reopeners, now that might be still a bit of mileage left in that.
Across the Tasman, the Australian market has dropped as well to the lowest level since 2020.
Yeah, that's right. We're pointing out that the Aussie market, the ASX 200, hasn't entered a bear market, down under 15% from that peak last year. But back to those sort of 2020 levels. The RBA, again, it's inflation, it's interest rates. The RBA shocked some by coming out with the rate rises and embarking on this tightening process. Again, they've been a little bit behind the curve, so I suppose there's been some concern there. But again, I think that market could potentially also bounce back. Financials very much dominate. Rising interest rates, in theory, should provide some net margin respite. I guess the concern is whether we start seeing borrowing stress. Resources sector, a lot of that will hinge on China. Recent data has actually been quite encouraging. So China's had the zero COVID policy, appears to be loosening that a little bit. And so that I think that'll be helpful to countries from China as their largest customer includes Australia, but of course New Zealand as well.
Going a little bit further overseas, what did you make of the reaction to the Fed?
Well, there's a positive initial reaction. Obviously, there was a lot of trepidation about that last week, particularly given we had the hot CPI print or inflation print the week before. So what was the Fed going to do? It came out with a 75 basis point rise. There was some saying it would be 50, some say it might even be 100. So I think 75, that was well received. I think the main concern, ironically, is whether the Fed has got behind the curve as it relates to controlling inflation. I think the decision showed that the Fed is serious about inflation. But I think the other positive takeaway is that the officials are quite optimistic that they can engineer almost a Goldilocks scenario, to use your words, a soft landing for the economy. And I think that was really well received because, the markets, you look at them, we're talking about the NZX50, we're talking about the ASX 200, we're talking about the S&P. They've been pricing in the worst case scenario. So I think, if that doesn't eventuate, then, we could well see a bit of a rebound.
So what else is on your calendar this week?
So we've got retail. We've got house sales out in the US. That's always in focus. We've got another inflation number out in the UK, 9%. It's expected to come in. So the Bank of England's got a bit of a balancing act to do as well. Closer to home, we've got the RBA minutes, so we'll get more of a steer on what officials are thinking there. And then we've got the GDT print that perked up last time, so it'll be interesting to see whether that trend continues. And related to that, we've got some trade figures out. So New Zealand exporters aren't doing too badly at the moment. And the lower currency has been helping that.
Wonderful. Well, thank you so much, Greg.
My pleasure.